Welcome back to Abhik Parth. In Chapter 5 of the Little Book of Common Sense Investing by John C. Bogle, we uncover one of the most crucial lessons in investing, focusing on the long term. Investing is not a sprint, it's a marathon. By staying committed to the long haul, you can reap the benefits of compounding and avoid the pitfalls of short-term thinking. Let's explore this concept with practical examples to make it clear. Many investors get distracted by short-term market movements, news headlines, and emotional impulses. But Bogle emphasizes that the key to wealth creation lies in focusing on the long term. Let's break this idea into actionable lessons, supported by real-world scenarios. Key Lesson 1. The power of compounding. Compounding works like magic over time. When you reinvest your returns, your wealth grows exponentially. The longer you stay invested, the greater your wealth becomes. Example 1. Amit's SIP journey. Amit starts investing 5,000 rupee monthly in an index fund at the age of 25. The fund grows at an average annual return of 10%. By the time he's 55, Amit's investment grows to 1.14 crore rupees. Now imagine if Amit had started at 35 instead of 25. With the same investment, he'd have only 41 lakh rupees. This difference of 73 lakh rupees is the power of starting early and staying invested for the long term. Key Lesson 2. Ignore short-term market volatility. The stock market fluctuates daily, but those fluctuations don't matter over decades. Short-term losses should never discourage long-term investors. Example 2. Mira's patience pays off. Mira invested 10 lakhs rupees in an index fund in 2008. Then came the global financial crisis, and her portfolio value dropped to 6 lakhs rupees within months. Instead of panicking and selling, Mira held on to her investments. Over the next 10 years, her portfolio recovered and grew to 30 lakhs rupees. Her patience and trust in the long-term growth of the market paid off immensely. Key Lesson 3. Stick to a simple, consistent strategy. Bogle argues that investing doesn't need to be complicated. The best strategy is to buy a low-cost index fund and hold it for decades. Example 3. Rajesh vs. Sanjay. Rajesh tries to time the market, constantly buying and selling stocks based on predictions. In contrast, Sanjay invests 1 lakh rupees in an index fund and forgets about it for 20 years. After 20 years, Rajesh's portfolio grew to 25 lakhs rupees, but his frequent trading cost him 5 lakhs rupees in fees and taxes. Sanjay's portfolio grew to 40 lakhs rupees with minimal costs because he stayed invested. This shows how a simple and consistent strategy outperforms complex and risky tactics. Key Lesson 4. Understand the role of patience. Investing requires patience. Quick gains might be tempting, but true wealth comes from giving your investments enough time to grow. Example 4. The tortoise and the hare. Think of investing as a race between a tortoise and a hare. The hare represents investors chasing quick profits, while the tortoise represents disciplined, long-term investors. Over a 30-year period, the hare might earn high returns in some years but lose big during downturns. The tortoise, by consistently investing in the market, builds steady and reliable wealth. As the old saying goes, slow and steady wins the race. Chapter 5 teaches us that long-term focus is the ultimate winner's game in investing. The power of compounding, patience during market downturns, and sticking to a simple strategy are your allies in creating lasting wealth. Always remember, the market rewards those who stay disciplined and committed for the long haul. So, invest wisely and let time work its magic. Movie Camera explore the full playlist for the Little Book of Common Sense Investing here, playlist link. Glowing star, share your investment journey in the comments below. How do you stay focused on the long term? Bell, don't forget to like, subscribe, and hit the bell icon for updates on the next chapter. Welcome back to Abhik Parth. In Chapter 6 of the Little Book of Common Sense Investing by John C. Bogle, we explore one of the most overlooked truths in investing: minimizing costs. Costs may seem small in the short term, but over time, they can eat away at your returns like termites in wood. Let's dive in and uncover the power of cost efficiency in building wealth, supported by practical examples. Key Lesson 1: The hidden cost of fees. Every rupee you pay in fees is a rupee that doesn't compound for you. Mutual funds and actively managed investments often come with high fees that reduce your overall returns. Example 1: Active fund versus index fund. Imagine you invest 10 lakhs rupees in two different funds. Active fund charges 2% annual fees. Index fund charges 0.2% annual fees. Both funds grow at 10% annually before fees. Over 30 years, the active fund grows to 57 lakhs 40,000 rupee after fees. The index fund grows to 91 lakhs 32,000 rupee after fees. This 33 lakhs 92,000 rupee difference shows how even a small fee difference can make a big impact over time. Key Lesson 2: The Arithmetic of Returns. Bogle emphasizes that the average market return is available to everyone. However, most investors underperform due to costs like fund management fees, transaction fees, and taxes. Example 2: The 10% market return. If the stock market delivers a 10% annual return, a low-cost index fund might return 9.8%, keeping costs minimal. A high-cost active fund might return only 7.5% after deducting fees and taxes. By choosing low-cost funds, you keep more of the market's return for yourself. Key Lesson 3: Turnover costs matter. Actively managed funds often buy and sell stocks frequently, incurring high turnover costs like brokerage fees, taxes, and bid-ask spreads. These costs are rarely transparent but significantly reduce returns. Example 3: Ramesh's trading mistake. Ramesh invests 1 lakh rupees in an actively managed fund with 100% turnover. The fund performs well, but high trading costs reduce its annual return by 2%. After 20 years, Ramesh's investment grows to 3 lakhs 20,000 rupees. Now compare this to Suresh, who invests the same amount in an index fund with minimal turnover. His investment grows to 6 lakhs 73,000 rupee over 20 years. Suresh's simple strategy allows him to outperform Ramesh by a huge margin. Key Lesson 4: Tax efficiency. Taxes can also erode your returns. Index funds are more tax efficient because they trade less frequently than actively managed funds, reducing capital gains taxes. Example 4: The tax impact. Consider two funds. Active fund trades stocks regularly, realizing short-term capital gains taxed at a higher rate. Index fund trades minimally, differing capital gains taxes until you sell. Over time, the tax savings of the index fund compound, leading to higher wealth for you. Choose low-cost index funds. Look for funds with expense ratios below 0.5%. Avoid frequent trading. Stick to a buy-and-hold strategy to minimize transaction fees. Be tax efficient, invest in funds with low turnover to reduce tax liabilities. Understand all fees, check the fine print to ensure you are not paying hidden costs like entry-exit loads. Chapter 6 teaches us that minimizing costs is not just an option, it's a necessity for long-term success in investing. Remember, it's not about how much you make, it's about how much you keep. By reducing fees, taxes, and unnecessary expenses, you can let your money work harder for you.